Hello folks, Steve Lentz here with Discover Options at OptionView. Welcome to this presentation of several market reports for advanced options traders. This is for Friday, July 21st, getting ready for Monday's open, July 24th. Presented material is for educational purposes only and should not be construed as personalized financial advice. Before we get going, I want to make sure you know that you can get a free ebook, Simple Steps to Options Trading Success, co-authored by myself and Jim Graham. Just click on the link, give us your information, we'll get that to you. Also, please subscribe. You can just click the subscribe button, and that way you'll get notified when we come out with new videos. All three of these reports are predicated upon this market condition that we're in as of Friday's close in the S&P 500. Price action: Thursday's action was an upswing day, higher high and higher low. Friday saw a downswing day, lower high and lower low. That price action occurred all above a 50-day simple moving average, and the 15-3 stochastic is over 60 and under 100 in that range, and we are below the %D. So that's a fairly unique market condition. There's been about a little over 150 occurrences of this particular market condition that's occurred since Jan of 2000. Okay, so let's get right to it then. For those of you that trade condors and butterflies and like to sell premium, option premium from a neutral market perspective, here's the report. So since January of 2000, there have been over 4,300 daily closes of the S&P 500. Now, of those 4,300, 65.5% have been favorable bars for selling premium, where the actual 21 bar movement moving forward was less than what was being implied by the SIBO skew adjusted VIX. Okay, the implied movement coming from that skew adjusted the option prices, the implied movement from the option prices. All right, now that's a favorable thing when the implied movement is less than what was being predicted by the option prices. Now, 65.5% of the bars were favorable like that. Also, during that time, our current market condition occurred 153 times. Now, of those 153, 75.2% of those were similarly favorable for selling option premium. That's higher than the baseline of 65.5. Okay, and so that's roughly about a 9.7% edge that we have right now. So you could flip a coin in the S&P, and 65% of the time you would have a bar that turns out to be favorable for trading butters and condors. Of the 153 times that our market condition has occurred in the past, 75% ended up being favorable. So we have an edge going on right now. It's just, so statistically, it's more likely than usual that this current market condition will end up being a favorable one for market neutral option premium selling. Okay, so that's the Condor butterfly timing report. Many of you, though, like to trade that way and lean things a little bit bullish. Perhaps you're selling out of the money puts, a standard deviation away 30 days out. Okay, so let's just assume that. And this is a bull put spread timing report for those of you that like to do that. Sell put premium, a standard deviation out of the money 30 days out. Okay, so we know that there have been over 4,300 daily closes of the SPX. Now, of those, from this perspective, almost 83% have been favorable bars for selling put premium like that, where the actual 21 bar downside movement was less than what the SIBO skew adjusted VIX was implying. All right, and so you could flip a coin, and 83% of the time the market would not move a standard deviation down and hit your put premium, your put strike, a standard deviation away 30 days out. Now, our current market condition occurred 153 times. Of those, 86.3% of the bars were similarly favorable for selling puts in that manner. So that implies an edge of over 3%, 3.4%, okay, over and above the baseline. So statistically, it's more likely than usual that Friday's bar will end up being a favorable one for selling the out-of-the-money put premium in that fashion. All right, now let's go to the likelihood report. And so this is the question on the table here is, based upon our current market condition and how well it's what's happened in the past, is the market likely to move up, down, or wobble around in the middle? Excuse me. Okay, so that's the question. And to answer that question, we have to do a study in price distribution. So what we do is we create these distribution bands. From the close, I go up 5, 10, and 15 days, 1 standard deviation levels up above the current close, and then we go down below the close 5, 10, and 15 day 1 standard deviation levels. And we ask ourselves whether price typically strikes those levels or not. And so let me show you just an example of this. Click here. Here we go. No, let me click escape and then go here. Perfect. Okay, so here's a picture of this. We have the close, and then we have the 1 standard deviation level above the close, and then 1 standard deviation level below the close. Now look at this. The upside band is a little bit closer than the downside band. Do you see that? And that's because I'm using a skew adjusted VIX level, so that the out-of-the-money calls typically have a lower implied volatility in the S&P cash options, and the puts, out-of-the-money puts, have a higher implied volatility, implying a larger move to the downside than to the upside. And that's being reflected in these bands. And so when we look at we have the 5-day and the 10-day and the 15-day. And so the question then is in the ensuing 5, 10, and 15 days, does price typically go up? And how often does it strike that 5-day? Or the one going out 10 days? Does it hit that one? Or the one going way out 15 days? Does price go up and hit that? And so with that in mind, let's take a look at here. And we can see then that when we measure 4,356 occurrences or closes of the S&P 500 going back to Jan of 2000, the upper 5-day band was struck 21.5% of the time. The upper 10-day band 15.8, the upper 15 14.8. The lower 5-day band got struck 16.6% of the time. The lower 10-day band 16.8, the lower 15 19.6. Isn't that interesting? Okay, so that's the baseline percentage levels that those bands got struck. Now, for the 154 occurrences of our current market condition that we have now, when you measure the distribution of price after those occurrences, the 5-day upper band got struck 12.3%, which is quite a bit less than the baseline by about 9%. That's a lot. The upper 10-day band got struck 10.4, again, much less than 15.8, a negative difference there. The 15-day band, 11 versus 14 point, another negative difference. In fact, on all 3 lower bands, those all got struck less often than the baseline. Okay, the differences are a bit less than over here on the upper bands. But one thing we also do is that we look at in the instances where the market goes above the previous day's high. So if price exceeds Friday's high, we would look to these 57 times that similarly has happened, and we would note that again all 6 bands got struck less often. And then the 89 occurrences where price went below that, in this case Friday's low, all 6 bands were struck less often. What is this saying? This is saying that this is a picture of lower market volatility. Lower market volatility. All 6 bands are getting struck less often, okay, across the board, in both instances when price exceeds the high or the low of Friday's band, or bar, excuse me. So there you have it. Clearly, the market likelihood is showing a picture of lower market volatility. If you were to lean one way or the other, I think you would have to lean perhaps a squeege bearish when you look at the percentages and the differences. The differences are less on the lower bands than on the upper bands. The upper bands are getting struck less often relative to the baseline compared to the lower bands. So if you were to lean it a little way, you would lean it bearish. But that's not saying much because these bands are getting struck less often by quite a bit across the board. So there you have it. Okay, let's click here, click here. All right, thanks for joining us. We'll be back next week with another report for the Advanced Options Trader. Take care. Have a great week. Bye-bye.